Chapter 11, Fundamentals of Risk and Return. Learning Objectives. After studying this chapter, you should know about concept of return on investment, calculating returns, simple, annualized, and compounded, risks in investment and measuring market risk, sensitivity analysis and concept of margin of safety, comparative analysis of equity and bond returns, calculating risk-adjusted returns, behavioral biases that influence investment returns, concept of return of investment and return on investment. Investment means putting up capital in an identified investment product to earn returns from it. The investor expects two things from the investment: to earn a return and, more importantly, to get back the capital invested. The preservation or safety of the capital invested is as important a parameter in evaluating an investment as is the return that it is expected to provide. The return from an investment needs to be evaluated in terms of the level of the return, the volatility in the return, and the nature of return, periodic or capital appreciation. The return that an investment generates in money terms is not a correct representation of its level of return. The return has to be seen in conjunction with the capital invested to earn it. Return on capital/investment, ROI, is the comparison of returns with the investment and can be defined for single period as return on investment, percent, equals net profit divided by investment times 100. Higher the potential ROI, better for the investors. As a decision tool, it is simple to understand. However, one has to be careful while using the ROI numbers for those investments where the returns are not known in advance, such as equity and mutual funds. In all such investments, estimates are based on past returns and assumptions are made for future returns. Calculation of simple, annualized, and compounded returns. The return on an investment can be calculated in different ways. The returns calculated must enable the following: help the investors decide if the return is adequate to meet their goals and to compensate for the risk in the investment. Help the investors compare different investments on the basis of returns. Help the investors evaluate the performance of an investment relative to benchmark. The returns from an investment can be in the form of periodic payouts such as interest, dividends, and rent, or in the form of appreciation in the value of the investments. An increase in the price of the investment forms part of the returns to the investor and used in the calculation of the ROI, whether it is realized or not. Together, they form the total returns from the investment. Periodic income may be known in advance, such as interest on fixed income investments, or it may change from one period to the next, as in equity dividends. In some investments, such as gold and other commodities, there is no periodic return at all. Either way, high or low, this is a positive cash flow for the investor. The other component of the return in some investments, the gain in value, can be positive or negative. That is, the investment may make a gain or loss. If it is a gain, then it adds to the returns. If it is a loss, then it eats into the periodic income, if any, that the investment has earned, and the total income comes down. The ROI calculated as total returns divided by total cost times 100 is the return earned over a particular period. For example, an investor purchased 150 shares of company ABC. Each share costs 25 rupees. The investor paid 20 rupees commission to the broker. The shares were sold at 30 rupees per share. The investor also paid 20 rupees commission fee to the broker for the transaction. The investor received dividends amounting to 1 rupee per share during the holding period. The total cost incurred is total cost equals shares multiplied by price per share plus commission fee. Total cost equals 150 multiplied by 25 rupees plus 20 rupees equals 3,770 rupees. Total returns equals dividends plus sales proceeds. Dividends equals 150 multiplied by 1 rupee equals 150 rupees. Sales proceeds equals number of shares multiplied by price per share minus commission fee. Sales proceeds equals 150 multiplied by 30 rupees minus 20 rupees equals 4,480 rupees. The simple return would be simple return equals 4,480 rupees plus 150 rupees divided by 3,770 rupees minus 1 is equal to 1.23 minus 1 is equal to 0.23. The simple return on the investments is 23%. This is called single period return or absolute return. However, this computation does not take the period over which the return was earned into consideration. A 23% return earned over a 1 year is not the same as a 23% return earned over a longer or shorter investment period. Return that does not take the investment horizon into consideration makes it difficult to compare between investments that have been held for different periods. This is facilitated by converting the return to a uniform period, that is, 1 year. This is called annualized return. The absolute return is converted into annualized return by dividing it by the number of months or days that the investment was held and multiplying it by 12 months or 365 days. In the earlier example, if the investor had held the investment for 15 months over which the 23% was earned, then the simple annualized return for the investment would be 23% divided by 15 multiplied by 12 equals 18.4%. The annualized return calculation does not take the time value of money into consideration. Time value of money is the concept that money has the ability to be invested to earn more money. Therefore, money received earlier is worth more than money received later. The compounded annual growth rate (CAGR) method of calculating returns takes this into consideration. CAGR calculations assume that the periodic returns received from an investment can be reinvested to earn returns, and this forms part of the total returns of the investment. It is calculated as the rate of return at which the original investment grows to the final investment value. CAGR is computed as end value divided by beginning value raised to the power 1 by n minus 1, where n is the holding period in years. In the earlier example, if this investment was held for 5 years, the CAGR is calculated as 3,770 multiplied by 1 plus r to the power 5 is equal to 4,630. 1 plus r to the power 5 is equal to 4,630 divided by 3,770 is equal to 1.23. And r equals 1.23 to the power 0.2 minus 1 is equal to 0.04227. Therefore, the compound annual growth rate on the investment comes to 4.2%. Please note that we have ignored the time factor in case of dividend. If we knew with precision when we received this dividend, we could calculate the future value of dividend at the time of liquidation of shares, that is, at the end of 5 years, dividend plus interest over the period. Consideration of this interest income would have increased our CAGR by some basis points. Compound annual growth rate allows for making a clearer evaluation of the performance of the stock, as it takes both holding period of investment and time value of money into consideration. CAGR is the smoothened rate of return at which the return grew to the final value over the investment period. The actual return in each year of the holding period may be different from the CAGR. CAGR is the accepted standard measure of return on investment in financial markets, except in case of returns that involve periods of less than 1 year. CAGR for multiple cash flows. Consider the following problem in which an investor receives intermediate cash inflows as well as final proceeds from the sale of his equity share. An investor buys an equity share on July 31, 2011 for 150 rupees. He receives a dividend of 5 rupees on October 31, 2011, 6 rupees on October 31, 2012, 4 rupees on October 31, 2013. He sells the share on January 15, 2014 for 165 rupees. What is the CAGR of his investment? This problem cannot be solved using the direct CAGR formula. The underlying CAGR for these multiple flows has to be calculated by using XIRR function in Excel. The procedure stated in the previous example can be followed here as well. Separate columns should be created for inputting dates and corresponding matching cash flows. A screenshot of the solution looks like this. As the box shows, the CAGR is 8.06%. The CAGR of an investment does not represent the actual rate at which the investment grew each year of the investment period. It is a smoothened average annual rate calculated based on the inflows and outflows from the investment. The actual underlying annual return may be volatile, and this reflects the risk in the investment. Risks in investments. Risk and return are an integral part of investing. The return that an investment generates cannot be seen in isolation from the risk that has to be assumed to earn it. A high return can be earned only if the investor is willing to take higher risk. Risk in an investment is the volatility and uncertainty in the returns, and in the extreme case, the loss of capital invested. An investment is also deemed to be risky if the actual returns earned are different from the expected returns. For example, a fixed deposit with a bank is seen as a lower risk product because the bank is unlikely to default on the interest payment or the return of the capital invested. On the other, investment in an equity product is seen as risky because the dividend is uncertain as to its level and when it will be received, and the value of the invested amount sees high fluctuations. All investments are subject to risks. The nature and extent of the risk may differ. It is important for an investor to be able to identify the type of risk in an investment to be able to decide whether it is suitable to their situation. For example, a retired investor may be willing to put up with the risk of insufficiency of returns earned to meet expenses, but may be unwilling to take the risk of loss of capital in equity investments, even if the returns are higher. Some of the common risks that are seen in investments are captured here. Inflation risk. Inflation risk represents the risk that the money received on an investment may be worth less when adjusted for inflation. Inflation risk is also known as purchasing power risk. It is a risk that arises from the decline in value of securities' cash flows due to the falling purchasing power of money. For example, Asha has invested a lump sum in bank fixed deposits that yield her about 5,000 rupees per month. This is adequate to cover the cost of her household provisions. Suppose that inflation rises by 10%, meaning that there is a general rise in prices of goods by about 10%. Then, 5,000 rupees will no longer be enough to cover Asha's monthly provisions costs. She would need 10% more, or 5,500 rupees. The purchasing power of her cash flows has declined. Asha would have to manage her budget at a lower level or reallocate her investments to earn higher cash flows. Her investment, though in a safe bank deposit, has been exposed to inflation risk. Inflation risk is highest in fixed return instruments such as bonds, fixed deposits, and debentures, where investors are paid a fixed periodic interest and returned the principal amount at maturity. Both interest payments and principal repayments are amounts fixed in absolute terms. Suppose a bond pays a coupon of 8% while the inflation rate is 7%, then the real rate of return is just 1%. If inflation goes up to 9%, the bond may return a negative real rate of return. Thus, even if there is no risk of default on payment of interest or return of principal, the real value of the investment has been eroded because of inflation. Inflation risk is fairly less for equity shares. If prices go up as a result of inflation, then all else held constant, businesses will see increase in selling price of their product and thus its profit should go up in nominal terms. This is also likely to reflect as higher stock prices. A case in point that demonstrates this is the hyperinflation in Venezuela. The country consistently had high inflation rates. However, it especially went through very high inflation from 2016 onwards, with inflation peaking at 65,370%, that is, prices increasing by around 654 times. In 2018, while bond investors suffered significantly as their investments became almost worthless, Caracas Stock Exchange stock market index increased by over 1,000 times in the same year. Interest rate risk. Interest rate risk refers to the risk that bond prices will fall in response to rising interest rates and rise in response to declining interest rates. Bond prices and interest rates have an inverse relationship. For example, an investor invests in a 5-year bond that is issued at 100 rupees face value and pays an annual interest rate of 8%. Suppose that after 1 year, the Reserve Bank of India cuts policy interest rates. As a result, all rates in the market start declining. New 5-year bonds are issued by companies with a similar credit rating at a lower rate of 7.5%. Investors in the old bonds have an advantage over investors in the new bonds since they are getting an additional 0.5% interest rate. Since investors want to earn the maximum return for a given level of risk, there will be a rush of investors trying to buy up the old bonds. As a result, the market price of the old bond will go up. The price will raise up to a level at which the IRR of the cash flows from the old bond is about 7.5%. This will take place for all bonds until their yields are aligned with the prevailing market rate. Suppose, instead, that policy rates are increased. New issuers of 5-year debt will be forced to offer higher interest rates of, say, 9%. Now, investors in the new bonds will earn more than investors in the old bonds. As a result, holders of the old bonds, which pay only 8% interest, will try to sell off their holdings and try to buy the new bonds. This market reaction will push down the prices of the old bonds up to the level at which the IRR of its cash flows exactly matches the market rate. The relationship between rates and bond prices can be summed up as: if interest rates fall or are expected to fall, bond prices go up. If interest rates rise or are expected to rise, bond prices decline. Bond investments are subject to volatility due to interest rate fluctuations. This risk also extends to debt funds, which primarily hold debt assets. Interest rate risk has an impact on equity investing as well, both in theory and practice. Theoretically, when cost of capital goes up, the present value of the cash flow goes up and vice versa. Thus, when interest rate increases, equity market should underperform. In practice, when interest rate goes up, there's lesser borrowings and thus lesser flow of funds. This in turn reduces demand for equity and pushes the price down. Business risk. Business risk is the risk inherent in the operations of a company. It is also known as operating risk because this risk is caused by factors that affect the operations of the company. Common sources of business risk include cost of raw materials, employee costs, introduction and position of competing products, marketing and distribution costs. Not all businesses are affected by the same risks. Holding a diversified portfolio is an efficient way to diversify this risk. Market risk. Market risk refers to the risk of the loss of value in an investment because of adverse price movements in an asset in the market. The price of an asset responds to information that impacts its intrinsic value. For example, an increase in interest rates reduces the value of the cash flows from existing bonds and therefore leads to a fall in the price of bonds, interest rate risk. An appreciation in the currency reduces the earning expectations of export-oriented companies and leads to a fall in price, currency risk. Market risk affects those investments where transactions happen at current applicable prices, such as equity, bonds, gold, real estate, among others. Investments such as deposits or small savings schemes are not marketable securities and the investor gets a predefined amount on maturity. They have no market risk, but they also do not gain in value. Credit risk. Credit risk or default risk refers to the possibility that a particular bond issuer will not be able to make expected interest rate payments and/or principal repayment. Debt instruments are subject to default risk as they have pre-committed payouts. The ability of the issuer of the debt instrument to service the debt may change over time, and this creates default risk for the investors. The sovereign government do not have a default risk associated with their local currency borrowings because the government has the ability to raise the funds to pay off its domestic currency debt through taxation or by printing more currency. All other borrowings have credit risk. Market participants measure the credit risk in an instrument based on the credit rating provided by the credit rating agencies. Credit rating is an alphanumeric symbol that expresses the credit rating agency's assessment of the ability and intention of the borrower to meet the obligations arising from the debt. SEBI has standardized the symbols used by credit rating agencies. Symbols such as AAA, A1 indicate the highest degree of creditworthiness, while D represents default status. The credit rating is not a static parameter and is liable to change every time there is a change in the fundamentals of the company that will affect its ability to meet its obligations. Typically, lower credit rating represents higher credit risk to reflect a greater perceived default risk, which results in higher interest rate expectations by the investors, higher cost of borrowing for the borrowers. Holding a diversified portfolio of bonds reduces the default risk. Liquidity risk. Liquidity risk refers to an absence of liquidity in an investment. Thus, liquidity risk implies that the investor may not be able to sell his investment when desired, or it has to be sold below its intrinsic value, or there are high costs to carrying out transactions. All of this affects the realizable value of the investment. The market for corporate bonds in India is not liquid, especially for retail investors. Investors who want to sell a bond may not find a ready buyer. Even if there were a buyer, the price may be lower due to the lack of liquidity. Investments in property and art are also subject to liquidity risk, since identifying a buyer and determining the price is a lengthy process in the absence of frequent transactions. Some investments come with a lock-in period during which investors cannot exit the investment. For instance, the following exhibit is a snapshot of the order book of sovereign gold bond, December 2025, as at end of July 17, 2020. As one can see, the difference between the best bid and the best ask price is over 80 rupees, equivalent to around 2%. Further, the quantity available for trade is also very low. Call risk. Call risk is specific to bond issues and refers to the possibility that a debt security will be called prior to its maturity. Call risk usually goes hand in hand with reinvestment risk, discussed below. Call risk is most prevalent when interest rates are falling, as companies trying to save money will usually redeem bond issues with higher coupons and replace them with issues with lower interest rates. Reinvestment risk. Reinvestment risk arises from the probability that income flows received from an investment may not be able to earn the same interest as the original interest rate. The risk is that intermediate cash flows may be reinvested at a lower return as compared to the original investment. The rate at which the reinvestment of these periodic cash flows is made will affect the total returns from the investment. The reinvestment rates can be high or low depending on the levels of interest rate at the time when the coupon income is received. This is the reinvestment risk. If interest rate rises, reinvestment risk reduces or is eliminated. If interest rate falls, reinvestment risk increases. Choosing the cumulative option available in most debt investments is a way for investors to protect the investment from reinvestment risk. In a marketable security, such as a bond, this may expose the bond to higher price volatility. Political risk. Risk associated with unfavorable government actions, possibility of nationalization, change in tax structures, licensing, etc. is called political risk. Because the government has the power to change laws affecting businesses/securities, almost all businesses are exposed to the political risk. Country risk. Country risk refers to the risk related to a country as a whole. There is a possibility that it will not be able to honor its financial commitments. When a country defaults on its obligations, this can affect the performance of all other securities in that country as well as other countries it has relations with. Country risk applies to all types of securities issued in that country. The risks in an investment can be categorized as systematic and unsystematic risks. Systematic risk refers to those risks whose impact is felt across investment categories. These risks are also known as undiversifiable risks because they cannot be eliminated through diversification. Systematic risk is caused due to factors that may affect the economy/markets as a whole, such as changes in government policy, external factors, wars, or natural calamities. Inflation risk, exchange rate risk, interest rate risk, and reinvestment risk are systematic risks. Unsystematic risk is the risk specific to individual securities or a small class of investments. Hence, it can be diversified away by including other assets in the portfolio. Unsystematic risk is also known as diversifiable risk. Credit risk, business risk, and liquidity risks are unsystematic risks. Investments will have a component of systematic and unsystematic risk. The following examples illustrate how an investment can be subject to both systematic and unsystematic risk. Ajay invests in equity shares of an infrastructure company. He believes that the company will do well because of the growing demand for infrastructure and the company's strong technical and managerial capabilities. Ajay's investment is subject to two main risks, business risk and market risk. Ajay can reduce his business risk by investing in other companies operating in different sectors. But an economic slowdown would reduce the profitability of all companies. This is the market risk in equity investment that cannot be diversified. Ashima is keen to invest in bonds issues. Her investment is subject to credit risk and interest rate risk. She can reduce credit risk by increasing the proportion of highly rated bonds in her portfolio. However, if interest rates rise, then prices of all the bonds held by her will decline. This is the interest rate risk, which is common to all debt investments. Measuring risk. We discussed many different sources of risk. An effective risk management technique involves measuring these risks. But before we measure, it is important to define risk. There are three ways in which risks are defined. 1. Measure of uncertainty. A very common way to define risk is that of uncertainty and unpredictability. This is calculated as standard deviation of the return of the assets. It is calculated as follows. S equals the summation of x minus x bar squared divided by n minus 1. Where x bar refers to the average rate of returns of the asset and n represents the numbers of observation in the sample. 2. Measure of sensitivity. This approach measures risk based on the sensitivity of the asset's prices to various risk factors. This measure varies by the type of asset. The following are some of the risk measures used for certain assets. Beta measures the sensitivity of the stock's performance to overall market performance. It is used largely for equities. Duration measures the sensitivities of a bond's price to small change in interest rates. Delta measures the sensitivity of the price of an option for a small change in price of the underlying asset. 3. Measure of loss. Risk can also be defined as probability of losing a sum of amount. Alternatively, it can be defined as the amount of loss one may sustain given probable scenario. A commonly used probability-based risk metric is value at risk. It is often referred as VAR. It measures the maximum loss one may suffer given a particular level of confidence. For instance, if VAR 1% of a portfolio is 12%, it indicates that there is 99%, that is, 100% minus 1% chance the loss in the portfolio would exceed 12%. In other words, there is 1% probability that loss would exceed 12%. Concepts of market risk, beta. Beta is a measure of the systematic risk of a security obtained by comparing the volatility in the investment relative to the market as represented by a market index. It measures the risk of an investment that cannot be diversified away. Beta of 1 indicates that the security's price will move with the market. Beta of less than 1 means that the security will be less volatile than the market. And beta of greater than 1 indicates that the security's price will be more volatile than the market. For example, if a stock's beta is 1.2, it's theoretically 20% more volatile than the market both on up and down moves. Beta is used in the capital asset pricing model, CAPM, a model that calculates the expected return of an asset based on its beta and expected market returns. Model assumes that the beta is the only reason why an investor should expect a return higher than market/index return. However, many value investors don't pay any attention to beta. For instance, Seth Klarman of the Baupost Group, a value investor, wrote, "I find it preposterous that a single number reflecting past price fluctuations could be thought to completely describe the risk in a security." Beta views risk solely from the perspective of market prices, failing to take into consideration specific business fundamentals or economic developments. The price level is also ignored, as if IBM selling at $50 per share would not be a lower risk investment than the same IBM at $100 per share. Beta fails to allow for the influence that investors themselves can exert on the riskiness of their holdings through such efforts as proxy contests, shareholder resolutions, communications with management, or the ultimate purchase of sufficient stock to gain corporate control and with it direct access to underlying value. Beta also assumes that the upside potential and downside risk of any investment are essentially equal, being simply a function of that investment's volatility compared with that of the market as a whole. This too is inconsistent with the world as we know it. The reality is that past security price volatility does not reliably predict future investment performance or even future volatility, and therefore is a poor measure of risk. Sensitivity analysis to assumptions. Securities analysts use financial models to value securities of different kinds. These valuations are based on several inputs/assumptions about future aspects of the business, and some of these assumptions may be critical ones. The output from the model is only as good or reliable as the quality of the variables that have been plugged into it. Many of the inputs may be assumptions or based on calculations after considering a number of factors. If sufficient rigor does not go into researching, collecting, and evaluating information, the accuracy of the inputs into the model may be poor, and thereby the output may not be reliable too. It is important to identify the critical variables in a valuation model and do an analysis of how the output will vary under different scenarios for the primary or critical variables. This is known as sensitivity analysis. For example, in a DCF valuation model, the discounting rate is a primary input to arrive at the value of the security. The discounting rate must reflect the risks inherent in the business. The assessment of the risks will impact the rate used in the model. Sensitivity analysis will look at multiple scenarios for the discounting rate and the impact on the final value. Typically, a best case and worst case scenario is considered along with the most likely scenario. Concept of margin of safety. Margin of safety is the term popularized by Mr. Benjamin Graham, known as the father of value investing, and his followers, most notably Mr. Warren Buffett. In simple words, margin of safety refers to the difference between value and prices when securities are bought at a price significantly below their intrinsic value. Higher the difference between value and price, that is, value higher than price, higher the margin of safety. While margin of safety allows an investment to be made with minimal downside risk, it doesn't guarantee a successful investment. However, it does provide room for error/cushion against an analyst's judgment on valuation of securities. Determining a company's true worth, its intrinsic value, is anyway highly subjective. There is no universal standard to determine how wide the margin of safety should be. Each investor must come up with his or her own number. Comparison of equity returns with bond returns. Bond and equity return vary as to the nature of return, the level of returns, and the composition of the returns. Bond returns are primarily from coupon income with some contribution from gains in value as a result of decrease in interest rates. Bonds are seen as lower-risk investments relative to equity because there is a predefined return from coupon and there may be a security created in favor of the bondholders. The returns bond investments earn is therefore lower. The primary risk in bond investment is the default risk. Higher the credit risk, greater is the interest that the borrower has to pay and the investor will receive. Equity returns are primarily from the appreciation in the value of the investment. The dividend is a small component of the total returns from the equity. There is no assurance on either the dividend or the appreciation, which makes equity investments risky. Returns that these investments have the potential to generate are also higher to compensate for the risk. Well-run companies try to pay regular and stable dividends to its investors. The value of the share in the market is influenced by the performance of the company as well as external economic factors that impact the company. Warren Buffett stated that investors should always compare the returns on bonds and stocks at the time of deploying their capital. If the rate of return on stocks is greater than the rate of return on bonds, one should buy stocks. And if rate of return on bonds is greater than the rate of return on stocks, one should deploy capital in bonds. Generally, at the time of distress in economies, interest rates go significantly down to give push to the economies, and at that time equities may be available at dirt-cheap valuations even on the basis of dividend yield. Calculating risk-adjusted returns. In general, high-risk investment strategy would produce higher returns. Therefore, when comparing two investment portfolio or strategy, it may not be appropriate to compare their absolute returns, as a high-risk strategy is likely to produce higher returns in the long run, but it will also be more volatile during this period of holding. Therefore, it is appropriate to use certain risk-adjusted return measures so that the returns are comparable. Some of these risk-adjusted measures are as follows. Jensen's alpha. Alpha, in general, refers to the excess return earned on investment compared to its benchmark. Alpha calculation does not factor in the difference in the level of risk between the investment and the benchmark. Jensen's alpha is an alternative measure of alpha that factors the risk. It is measured as the excess return earned by a portfolio over and above the cost of equity that is calculated using CAPM. It is calculated as follows. Jensen's alpha equals return on portfolio minus risk-free rate plus beta multiplied by market risk premium. Higher the Jensen's alpha, the better it is. Sharpe ratio. Sharpe ratio measures the risk premium earned per unit of standard deviation. The risk premium earned is calculated by subtracting risk-free rate from the investment return. It is calculated as follows. Sharpe ratio equals return on portfolio minus risk-free rate divided by standard deviation. Similar to Jensen's alpha, higher ratio indicates superior performance. Trainer ratio. Trainer ratio measures the risk premium earned per unit of beta. The risk premium earned is calculated by subtracting risk-free rate from the investment return. It is calculated as follows. Trainer ratio equals return on portfolio minus risk-free rate divided by beta. Like the other two, higher ratio indicates superior performance. Basic behavioral biases influencing investments. According to conventional financial theory, the world and its participants are rational human beings and strive to maximize their wealth prudently. However, there are many instances where emotion and psychology influence our decisions, causing us to behave in unpredictable or irrational ways. Dean of Wall Street, Mr. Benjamin Graham, stated in his popular book, The Intelligent Investor, that markets are more psychological and less logical. Behavioral finance, a relatively new field of finance, attempts to combine behavioral and psychological theory with conventional economics and finance to provide explanations for why people make irrational financial decisions. Simon Savage, co-head of European and Global Long/Short Strategies at GLG Partners, a hedge fund manager owned by Man Group, said, "We were all born to be bad fund managers because of inbuilt behavioral biases, which are present in everyone to various degrees. It's through an awareness of them that as a fund manager you can begin to build a defense mechanism to avoid these vulnerabilities. Ignore them at your peril. Here are some of the main behavioral biases that investors need to look out for. Loss aversion bias. Loss aversion refers to investors' tendency to strongly prefer avoiding losses to acquiring gains. The fear of loss leads to inaction. Studies show that the pain of loss is twice as strong as the pleasure of gain of a similar magnitude. Investors prefer to do nothing despite information and analysis favoring a particular action that in the mind of the investor may lead to a loss. Holding on to losing stocks, avoiding riskier asset classes like equity when there is a lot of information and discussion going around on market volatility are manifestations of this bias. In such situations, investors tend to frequently evaluate their portfolio's performance, and any short-term loss seen in the portfolio makes inaction their preferred strategy. Confirmation bias. Confirmation bias, also called my side bias, is the tendency to search for, interpret, or prioritize information in a way that confirms one's beliefs or hypotheses. It is a type of cognitive bias and a systematic error of inductive reasoning. For example, when a trader buys a stock for a reason and that reason doesn't work out, so the trader makes up another one for owning the position. Similarly, first we make decision in mind and then find for the information to justify that intuitive decision. Ownership bias. Things owned by us appear most valuable to us. Sometimes known as the endowment effect, it reflects the tendency to place a higher value on a position than others would. It can cause investors to hold positions they would themselves not buy at the current level. Gambler's fallacy. Predicting absolutely random events on the basis of what happened in the past or making trends when there exists none. It is the mistaken belief that if something happens more frequently than normal during some period, then it will happen less frequently in the future, or that if something happens less frequently than normal during some period, then it will happen more frequently in the future, presumably as a means of balancing nature. Winner's curse. Tendency to make sure that a competitive bid is won even after overpaying for the asset. While behaviorally it is a win, financially it may be a loss. Herd mentality. This is a common behavior disorder in investing community. This bias is an outcome of uncertainty and a belief that others may have better information, which leads investors to follow the investment choices that others make. Such choices may seem right and even be justified by short-term performance, but often lead to bubbles and crashes. Small investors keep watching other participants for confirmation and then end up entering when the markets are overheated and poised for correction. Most of the individuals don't go against the crowd. As economist John Maynard Keynes said, it is better for reputations to fail conventionally than to succeed unconventionally. Anchoring. Anchoring is a cognitive bias that describes the common human tendency to rely too heavily on the first piece of information offered when making decisions. Investors hold onto some information that may no longer be relevant and make their decisions based on that. New information is labeled as incorrect or irrelevant and ignored in the decision-making process. Investors who wait for the right price to sell even when new information indicate that the expected price is no longer appropriate are exhibiting this bias. For example, they may be holding on to losing stocks in expectation of the price regaining levels that are no longer viable given current information, and this impacts the overall portfolio returns. Actually, the decision should be made purely on the basis of what price and value difference exists today in light of available information rather than based on what the prices were in the past. Projection bias. We project recent past to the distant future, completely ignoring the distant past. Some pearls of wisdom from investment gurus across the world. Stock markets are subject to bull and bear cycles. A bull market is when buyers are willing to pay higher and higher prices as the overall optimism for better future performance of stocks is high. This happens when businesses are expanding, growing at an above-average rate, face favorable and growing demand for their products and services, and are able to price them profitably. Or this could just be a change in perception or excessive liquidity in the system. The returns to equity investors go up as stock prices appreciate to reflect this optimism/liquidity or perception change. But a bull market can overdo its exuberance. As buyers pay higher and higher prices for stocks, prices move beyond what can be justified by the underlying intrinsic values. Also, businesses tend to overarch themselves, borrowing to fund expansion based on optimistic forecasts. Input costs for raw materials and labor and interest costs for capital increase as the bull market reaches its peak. Unrealistic expansion in prices tends to correct itself with a crash. The bull market paves way to a bear market when stock prices fall and correct themselves. A downturn in economic cycles can lead to stress for several businesses when they face lower demand for their products and services, higher input and labor costs, lower ability to raise capital, and in many cases risks of survival. When the economic conditions change, several businesses that began profitably may come under stress and begin to fail. Bear markets in equity reflect this pessimism. Stocks prices fall. Sellers quit in despair, accepting a lower price and a loss on their stocks. As prices may fall well below intrinsic values, buyers who find the valuation attractive will start coming into stocks that now are priced reasonably or lower. Central bankers reduce the interest rates to give push to consumption and investments, and slowly the bear cycle gives way to the next bull cycle. While booms and busts are the way of market, maintaining sanctity and discipline is what great investors in the world teach us. Benjamin Graham, a renowned value investor, used an allegory of Mr. Market to explain how investors should not be swayed by market price movements. His parable is set in a scenario where an investor has invested $1,000 in a business along with his partner, Mr. Market. The latter does a daily assessment of value of the firm and lets the investor to increase or decrease his share based on the same. While the Mr. Market's assessments were sometimes based on actual business events, they were often swayed by Mr. Market's own emotions. Benjamin Graham's proposition was that under such circumstances, the investor should not let Mr. Market's personal emotions drive their own emotions. Rather, they should look for opportunities to exploit when Mr. Market misprices the product because of his emotions. Here are some other pearls of wisdom from some of these great masters. Benjamin Graham. To achieve satisfactory investment results is easier than most people realize. To achieve superior results is harder than it looks. In the short run, market is a voting machine, but in the long run, it is a weighing machine. Charlie Munger. Understanding how to be a good investor makes you a better business manager and vice versa. David Dreaman. Psychology is probably the most important factor in the market and one that is least understood. John Templeton. Invest at the point of maximum pessimism. Peter Lynch. Go for a business that any idiot can run, because sooner or later, any idiot is probably going to run it. Walter Schloss. If you can't find good value investing positions, park your money in cash. Warren Buffett. Rule number 1 is never lose money. Rule number 2 is never forget rule number 1. One may refer to several books on investments or just do Google on each of these investors to be able to access hundreds of pearls of wisdom on investing and general life shared by these great investors and many more similar to them. Measuring liquidity of equity shares. One of the main objectives of stock exchanges is to provide liquidity, that is, the ease of buying and selling. However, not all shares are liquid. Liquidity can be achieved when there are a large number of buyers and sellers for a given stock. Liquidity of a stock can be measured using the following metrics. 1. Stock turnover ratio. This ratio is calculated by dividing the number of shares traded during a given period by the number of outstanding free float shares. Mostly, the time frame used is 1 year. Free float shares refers to number of shares held by non-promoter group shareholders. 2. Traded value turnover ratio. This ratio is similar to stock turnover ratio. It is calculated by dividing the traded value of the shares by the market capitalization of the company.